What's going on, everybody? So it's no surprise that when somebody buys a property, they rarely buy the property with 100% cash. In fact, a report published this year by the National Association of Realtors revealed that 87% of buyers utilized a home loan to purchase their homes. So how much cash do you actually need? Well, assuming you're not part of that 13% who are paying all cash, you'll need to start saving money so that you can afford the down payment that may or may not be required when you purchase your new home. Down payments are generally expressed as a percentage of the purchase price, and the type of loan and a handful of other factors will determine how much cash you need to bring to the table on closing day. Real quick before we get started, if you find the information in this video helpful, which I'm sure you will, consider hitting the like button and subscribing. It only takes you 1 second, and it helps me by providing feedback so that I can better tailor these videos to your needs. Oh yeah, and make sure you stick around until the question of the day towards the end of the video so that we can continue this discussion about today's topic in the comments below. All right, now that that's out of the way, let's talk financing. So the majority of loans that are being used today really fall under one of two categories. The first being government-backed loans, which can start as low as 0% down, and the second being conventional loans, which can go from as low as 3% down to 5%, 10%, 20%, or even higher, depending on how much cash you are looking to deploy. So let's start with the latter. Okay, wait. Let's back up for a second. There are indeed loan products out there which will allow you to put down as low as $0 down when you want to purchase a house. The most common two types are going to be your VA loan and your USDA loan. A VA loan is a mortgage loan that's guaranteed by the United States Department of Veteran Affairs, or the VA for short. And if you couldn't tell already, the VA loan is reserved for U.S. veterans, service members, and select military spouses. Now, the VA loan really has a few really huge benefits. These are things such as no down payment required, really competitive interest rates, and best of all, no need for PMI or private mortgage insurance, which we're going to be getting into a little bit later in this video. Now, it's not all good news here. There are a few cons associated with the VA loan. The biggest one being there are many requirements that you must fit in order to qualify for the loan. As with most other governmental-backed loan programs, the VA is known to be especially stringent when it comes to these requirements. You can only use one VA loan at a time. The subject property will usually be required to pass Section 1 and 2 inspections. And this is a loan for your primary residence only, which means no non-owner occupant investment properties, for example. And one last thing, occasionally sellers and agents may not be familiar with the VA loan, potentially making it more difficult to get your offer accepted. This is why it's important for you to work with an excellent agent who understands your needs and can help you accomplish your goals. So that said, if you can qualify for the VA loan, definitely don't sleep on it because it can be a really good option if there's a way to make it work for you. All right, so next we're going to talk about USDA loans, or United States Department of Agriculture loans. And I'm not going to spend too much time on this one because if you live in a metropolitan area, you're automatically ineligible. And yes, that's right, the same governmental organization that certifies that juicy steak in your fridge also has a mortgage program that you can apply for. Now, the USDA is the flagship mortgage program for the United States Department of Agriculture, but don't be fooled by the name. The USDA loan is not just for farms. As you look at an eligibility map for the USDA, all of the yellowish shaded areas are not eligible for this loan. So as you can see, they're for homes in less densely populated areas, and surprisingly, 92% of the US is eligible for this loan product, with only 8% left ineligible. Here in Sacramento, for example, you'll notice that you really don't have to travel far in any direction before you're in areas that are eligible. And it's definitely worth adding that some of these areas are still very desirable and in close proximity to pretty much some of the best outdoor recreation California has to offer. All right, so these next two types of loans are going to be the most common types of loans that we see today. And yes, you guessed it, these are going to be FHA loans and conventional loans. An FHA loan is a mortgage that's insured by the Federal Housing Administration. They're especially helpful for people that have either low credit or can't afford a higher down payment. Now, it's important to note here that the FHA isn't the one that's actually loaning you the money. They're just insuring the mortgage that you're getting. That insurance protects lenders in the event that you don't pay your mortgage and you default on your loan. This is why FHA lenders are still able to offer favorable terms to borrowers who may not otherwise qualify for a loan. FHA requirements in 2021 require a credit score of higher than 500, which we'll break into in a moment, and they always require MIP, or a mortgage insurance premium. You also must have a debt-to-income ratio of less than 43%. Now, for those that aren't familiar with this, to figure out what your DTI is, you basically add up all of the debt that you have and you divide it by your annual income. This will give you your DTI expressed in a percentage rate. The lower the number, the better. And just like the USDA loan and the VA loan, the subject property must be the borrower's primary residence, meaning you'll have to commit to living in the property for a certain amount of time before you can move out of the property and still hold on to it. Now, the obvious benefit with the FHA loan is the low down payment that's required. You can go down as low as 3.5%, and even if you don't have a favorable credit score, you don't have as much to worry about. If your credit score is 580 or higher, you'll be eligible for a 3.5% down payment. With a credit score between 500 to 579, 10% down is the lowest that you'll be able to go. So as you'll notice, with a credit score between 500 to 579, you're considered a more risky buyer. So generally 10% down is the lowest you'll be able to go if that's your situation. Another cool feature is the 203K loan. The 203K loan allows you to take out additional financing for a rehab budget and wrap that into your mortgage cost with your FHA loan. So the FHA loan in conjunction with the 203K loan can be a really excellent option if you can qualify for it. One big thing to keep in mind though is that the subject property that you're purchasing needs to be in livable condition in order for you to even qualify for the FHA loan in the first place. So you're not going to be able to just go and purchase a really distressed property and flip it like you may be able to do with other loan options. And one last thing, the process of utilizing a 203K loan, since it's adding additional hoops that you need to jump through, can be a little bit more challenging and pretty annoying. So let me know down in the comments if you want more information on that. All right, so this brings us to the last loan type that we're going to be talking about in this video, and that is conventional loans. A conventional loan or a conventional mortgage is pretty much any mortgage product that is not backed or offered by a government entity. Instead, conventional mortgages are offered through private lenders such as credit unions, mortgage companies, and banks. So the question becomes, conventional or FHA? I mean, they both offer low down payments, so which one's better? The answer really depends on the personal financial situation of the borrower. For example, let's say you have a higher credit score in the 740 range and you can afford a 20% down payment, then 9 times out of 10, the conventional mortgage is going to give you a better interest rate and lower fees than the FHA. But even if you're going conventional with a lower down payment, you'll still typically see lower interest rates, higher loan limits, and more flexibility with a conventional compared to their counterparts. Today, when you break it down, credit scores, debt-to-income ratios, and increased mortgage monthly payments are all reasons why we're seeing more people opting for low-down conventional mortgages over those going with FHA loans. So if you can obtain a loan with a lower down payment, why not go with the lower down payment? Well, unfortunately, there is one caveat to going with a lower down payment. Remember those acronyms that I mentioned earlier, PMI and MIP? Those are both insurance expenses that are often incurred when you put down less than 20% down on your home loan. But what are they and how are they different? PMI, or private mortgage insurance, is normally required on conventional loans when you put down less than 20% down. Now, a big thing to note here is that the PMI can be knocked off early once you reach that 20% equity. The MIP, or mortgage insurance premium, is required on all FHA loans, and this part is important. It typically lasts for the life of the loan, and you cannot get rid of it unless you change the mortgage by refinancing or get rid of the mortgage altogether. This is an aspect of FHA loans that you must take into consideration. I strongly recommend you run the numbers and see what that increased monthly payment will do to your finances long term. In addition, the PMI can sometimes be avoided with conventional loans that have less than 20% down, but with an FHA loan, that MIP is always going to be required. Whether or not those added expenses are worth it to you are really going to just depend on your personal situation, your goals, and your needs. So the question of the day, do you think these PMI expenses are worth the lower down payment? And what loan product would you use or have you used in the past? Write your answers down in the comment section below and we can get into this a little bit deeper. Another important thing to note here, if you're on the fence about should I go low down payment, should I not, should I wait? On average, people make more money through the appreciation of their property than they do those PMI payments. So often, whichever route is going to get you into a house and start paying your own mortgage down instead of building somebody else's wealth by renting is often the better choice to go for. So the appreciation is definitely something that needs to be taken into consideration. I mean, here in Sacramento where I'm at, we've seen over 20% appreciation with the average home values in Sacramento County year over year from this time last year. All right, and lastly, I just want to go over a few actionable steps that you can be taking right now. The first is going to be check your credit score and get familiar with it. Figure out what are the things that make up your credit score and are there any things that you can work on? Are there any disputes that you can take care of? Oftentimes, just a little bit of work can raise your credit score by an amount that will give you better terms when you go to get a loan. The second thing I would recommend is figure out what your DTI is, or your debt to income ratio. You can do that by using the method that we went over earlier in the video. Thirdly, call up a lender. See what options they have. Oftentimes, a lender is really going to give you the best financial snapshot so that you really know kind of what are areas that you need to improve and what are your options that you're currently looking at today. And if you're in Central California and in need of a lender, don't hesitate to reach out and we can connect you with our database of premier lenders in our area. All right, so this last step is going to be pretty obvious. If you haven't done so yet, start saving money for your down payment. After you've done the other 3 steps and you've spoken to a lender, you'll have a good idea of which loan options you can qualify for and how much money you'll need to save for each. All right, guys, so that's going to be it for this one. If you found this information helpful, please consider liking and subscribing so that you don't miss out on future content just like this. As always, thanks for watching, and we'll see you next time.